Good evening, guys. Evening. Sure you had a great day. Can you hear me loud and clear? Please drop a comment. Can you hear me loud and clear? Evening. Sure you had a great day. Thanks for joining this evening session. Believe you all can hear me loud and clear. If you can hear me loud and clear, please drop a comment. Drop a comment if you can hear me loud and clear. Can you hear me now? Can you hear me now? If you can hear me loud and clear, let me know. If you can see the screen, also let me know in the comment section. Mr. Atunda, I believe you can hear me now. Please confirm if you can hear me loud and clear, and also you can see my screen. So I just want us to do market review, okay, and also backtesting using resistance and support and candlestick pattern. I'd like to know, what strategy do you trade with? Please drop it in the comment section. What strategy do you trade with? One of the things you must do to become a profitable trader, a successful trader, is backtesting. If you're a trader and you don't backtest, you hardly make it in trading if you don't backtest, if you don't spend time on the chart. If I ask how many of you spent time in the charts yesterday, today, I'm sure most of you didn't spend time on the charts. After the close of the market, that is when most of you close the chart and never look at the chart, which is very wrong. The last time most of you looked at the chart was on Friday evening. Did the market close? You close the chart, that's all. It's maybe tomorrow evening or on Monday, that is when you would open the chart. If you keep doing that, you won't grow as a trader. Especially if you're new to trading, you need to spend hours on the charts. You need to spend hours on the chart. Okay, you need to spend hours on the chart. Let me know in the comment section, what strategy do you apply in the market? I'd like to know, what strategy do you apply in the market? So I just want us to do a review. Let's start with this past week. Okay, let's do a review. It's very important at the end of the week, you do a review. Okay, you do a review. When you execute a trade and the trade didn't play out as expected, on that day, after the close of market for that day, you're supposed to do a review. You're supposed to do a review. And also, after the close of the market for the week, you are supposed to do a review. You should find out why your strategy didn't play out, why the trade didn't go as expected. It's something you should do every day. There must be a reason why your strategy didn't play out. You need to find out. It's very important. Most traders don't do this. And that's why they say 90% of traders fail. Most are not willing to do the work. Many are not willing to do the work required to achieve success in trading. If you want to be a successful trader, you must be willing to put in the work. You must be willing to put in the work. Okay? You must be willing to put in the work. So let's just do a review. So today we'll just be using, let's say we'll be using support distance and candlestick pattern. I want you guys to share what strategy you're trading with, see if we can do a back test. Okay, using your strategy. Okay, but let's just use resistance and support. I know a lot of people know about resistance and support. So can you guys hear me? Can you guys hear me? Can you guys hear me? I didn't call this session for analysis, not for weekly outlook. It's just for us to back test. Let's apply some strategies on the chart and let's see how effective these strategies are. Okay, that's the reason for this session. Not I didn't call for analysis. Okay, I didn't call for analysis. I just want us to do a back test. Let's apply some strategies and just do some back test. Let's see how these strategies has worked in the past. When you do a lot of back testing, when you spend time on the charts, when you do a lot of back testing help build confidence. It helps build confidence. It helps build trust. When you backtest a lot, you trust your system. You trust your system. Even if you're experiencing losses, when backtesting, you know the winning rate of that strategy. If you backtest that strategy, you would know the winning rate of that strategy, 60%, 70%. So if you have 3 losses in a row, you know that the fourth one, there's a high probability it's going to play out. And if it plays out, the profit you make on that fourth one will cover for the losses you made in the previous trades. It helps build confidence. Most of you see your strategy, you see your setup, you are scared of executing the trade. That's because you've not backtested that strategy enough. That's the reason. You've not backtested that strategy enough. You don't have confidence in that system. That's why you panic or you get scared when you see the setup on the chart, you get scared. So you need to do a lot of backtesting. So like I said, let's just look at this week. Let's use GBP USD. So on Monday, this was the first candle for the week, right? This was the first candle for the week. Monday, Tuesday, Wednesday, Thursday, Friday. So let's start with Monday. Monday was strongly bullish, right? Like I said, we'll be using candlestick pattern and just resistance and support. Okay, so Monday, GBP USD did over 70 pips. Okay, over 70 pips. So for those who bought on Monday would have made profit. So let's go down to 4 hour. Now on the daily time frame, what pattern do we have on the daily time frame? We have what looks like a bearish reversal pattern. We had a spine top here. We had an angry man. We also had an angry man. All these are bearish reversal pattern. All these are bearish reversal pattern. But you can see that the price didn't drop, right? This pattern didn't play out as expected. Why? This is what you do when you are backtesting. Why is it that this pattern didn't play out? Price is supposed to drop, right? After the formation of all this pattern, price was supposed to drop. But why didn't it play out as expected? Why? So on Friday, last Friday, we had this is an angry man. Now, if you go back here, you would see that we had a support here. You can see this support level has been tested the first time, second time, and the third time. And you can see there has been a rejection, a struggle. The sellers have been trying to push price below the low of this candle, below this support level, which is a demand area. But they've not been able to push price below that level. Can you see that? So there was a rejection from this level. This tells me that there are more intending buyers. We still have buyers in the market who are willing to push price up. That's why the sellers have not been able to push price below this low. If last Friday candle had closed below this resistance, some support, we could conclude that supply has increased. We could conclude that supply has increased. We could conclude that we have more bears in the market. Then we can go ahead and start selling. But the fact that they've not been able to push price below this resistance turn support, there's a high probability that price will still go up. So after the close of this candle last Friday, what we would have done was to go down to 4-hour time frame. Let's see the pattern on 4-hour time frame. If it's a bullish reversal pattern, then we should have considered buying, right? We should have considered buying. We should have considered buying GBP USD. Backtesting is going back. First, you come up with an hypothesis. Okay, you come up with an hypothesis. It's okay. If you know how to identify candlestick patterns, you can say, okay, let's say you want to work with hammer candle. You can say, okay, whenever I see an hammer candle, I want to buy. Let's say that's your hypothesis. You say, okay, this is what I want to see on the chart. Then you come on the chart and start going back. You'll be looking for those patterns, hammer, where hammer formed. What happened when an hammer formed on the chart? That is what backtesting is all about. First, you have an hypothesis. you know what you're looking for on the chart, right? You know what you're looking for on the chart. Then you go back and see how the market reacted after the formation of that pattern. That's what backtesting is all about. You go back, go back. You can go as far back as year 2000. If you have the time, go as far back as year 2000 and see how the market reacts to that candlestick pattern, which is an hammer. If it is an engulfing pattern, you go back and identify where engulfing pattern formed and see how the market reacted after the formation of that pattern. That is what backtesting is all about. Going back to see how that strategy passed. That is backtesting. I hope that is clear, Mr. Debayo. Okay, so coming down to the next lower time frame, which is 4-hour time frame, you can see the pattern we have here on 4-hour time frame. You can see the pattern we have here on 4-hour time frame. Price is sitting at a support level. Good evening, Mr. Joseph. Good evening, Mr. Debayo Lee. Yeah, who else again? Okay. Okay, so if you go down to lower time frame, what do we have here? We have this candle here that looks like an hammer. And when a bearish hammer form like we have it here, when a bearish hammer form, hammer indicates change in trend. Anytime you see an hammer form in a downward trend, anytime you see an hammer form in a downward trend, it indicates change in trend from bearish to bullish. Okay, it indicates change in trend from bearish to bullish. But because the body of this bearish hammer, the body of this hammer is bearish, it indicates that we still have sellers in the market. Remember, I said when you see an hammer, it indicates change in trend from bearish to bullish. It indicates that the trend wants to change from bearish to bullish. But if the body is still bearish, if the body of that hammer is bearish, it tells you that there are still sellers in the market. And since the plan is to buy after the formation of an hammer, we have to wait for more confirmation. Before you buy, before you place a buy trade, you must see a bullish candle form. A bullish candle must form on the chart before you consider buying or before you execute a buy trade. So after the formation of this hammer, because the body is bearish, you have to wait for this next candle. This is the candle that confirms that there are buyers in the market. You can't jump in and start buying after the formation of this hammer. Yes, if you had entered after the formation of this hammer, the trade would have gone in your direction and you would have made good profit. But the risk executing a buy trade after the formation of this hammer is higher than waiting for this to form before you take a buy. I tell you, with just candlestick pattern, if you master candlestick pattern, you can earn consistently from the market. I've always said it, the strategy mustn't be complex to make you profit in this market. Keep it simple. Profitable traders keep their strategy simple. Keep it simple. Especially for those of you that are new to trading, keep your strategy simple. Don't complicate things for yourself. Keep it simple. If you're a new trader, keep it simple. Learn to identify candlestick pattern, resistance and support on the chart. That is all you need to get started. I've learned several strategies and I'm telling you that all you need is candlestick pattern, resistance and support. With these two price action strategy, you can earn consistently from the market. Okay, so we can see what we had there. This was on Monday. This was on Friday. Okay, on Friday, last Friday. So on Monday, you can see Monday was bullish. Can you see that? Monday was bullish just by following this candlestick pattern here. Also, if you go down to 1 hour time frame, you will be able to identify. Some of you might want to argue that, okay, this is not an hammer, right? Because for a candle to be an hammer, the wick below it must be at least 2 times the body. For a candle to be an hammer, a valid hammer, the wick below it must be at least 2 times the body. As you can see, this wick is not 2 times the body. It's not 2 times the body. I think the wick is equal to the size of the body. Okay, I think I need to switch network now. I think the network is. How is it now? Can you hear me now? Sorry for that break. Can you hear me now? Is it better now? Please confirm you can hear me now. Confirm you can hear me now. Can you hear me now? All right, thank you. Thank you. Thank you. Okay, so like I said, this candle will be called a valid, and below it should be 2 times and the wick below it. So as you can see, argue that this is not a valid hammer, right? One argue that this is not a valid hammer, right? But if you go down to after pattern on 4-hour time frame, after pattern on 4-hour time frame, after the close of this on 4-hour time frame, if you go down to 1 hour, I'm sure you would be able to identify a bullish reversal pattern on 1-hour time frame. Let's confirm. So you can see the pattern we have on 1-hour time frame. Can you see the pattern we have on 1-hour time frame? Can you see the pattern we had on 1-hour time frame after the close of that pattern on 4-hour time frame? This is the pattern we had on 1-hour time frame. Now this candle is called Marubuzu. This candle you see here, this candlestick pattern is called Marubuzu. Marubuzu, which indicates change in trend from bearish to bullish. You can see. So on 1 hour, we had a bullish reversal pattern. Okay, so the candle that closed here on 1-hour time closed above the high of this candle. Can you see? The last 1-hour candle, you see, it closed above the high of this bearish candle. So if we see all these candles as one candle, we could say we had an engulfing pattern on 1-hour time frame. Are you guys with me? If we combine all these candles together, we could say we had an engulfing pattern on 1-hour time frame. I know what most of you have learned about engulfing candle is just one candlestick closing above. Okay, that's what you guys have learned as engulfing. When a candle closes like this one, this is what you guys know as an engulfing pattern. When just one candle closes above the high of the previous bearish candle closes the hand. This is what you guys know as engulfing candle. but several candles can make up. Okay, a several candles, combination of several candles can also be called as engulfing. For example, what we have here, this is an engulfing pattern. If you combine this candle and this candle together, in as much both candles close below the low of this last bullish candle, that is an engulfing pattern. This is an engulfing pattern. Okay, so you can see that on 1 hour time frame we had an engulfing pattern. Let's go back to 4 hour time frame. Okay, so we're just back testing. We're just doing a review of price action for this past week. That's what we're doing. Okay, using candlestick pattern and resistance and support. So, okay, that's for Monday. Monday was strongly bullish. Let's go to Tuesday. What happened on Tuesday? What happened on Tuesday? On Tuesday, this was Monday and this was Tuesday. See what we had here on Tuesday. This was, let's go back to Tuesday. This is Tuesday candle. Go back to 4 hour. So you can see how this was the last candle that formed on Monday. Can you see that? This was the last candle that formed on Monday. This was the last candle. And what candlestick pattern is this? What candlestick pattern is this? This is a doji. This is a doji. Doji indicates indecision in the market. Doji indicates indecision in the market. When a doji forms in an upward trend, just as we have it here, when a doji forms in a bullish trend, it indicates that the buyers are becoming exhausted. That's what a doji indicates. When a doji forms in an upward trend, it indicates that the buyers, the bulls, are becoming weaker. And there's a high probability for price to pull back from that level. This doji indicates that we have equal supply and demand during this session. That's what this doji indicates. We had an equal number of buyers and sellers in the market. It's equilibrium in the market. Okay, so you can see the preceding trend. So if the preceding trend is bullish, you should expect price to pull back after the formation of this doji. And you can see how it played out on Tuesday. This was Tuesday. This was the first candle on Tuesday, second, and the third candle was bullish. Now, if you're to trade doji pattern, because this candle is an indecision candle, we can't just jump in and start selling. This tells us there is indecision in the market. This does not tell us that we have more buyers than sellers. This candlestick pattern does not tell us that we have more sellers than buyers. It just tells us that the buyers, the bulls, are becoming exhausted. That's what this candle tells us. It has not confirmed that we have sellers in the market. It just confirmed that the buyers are becoming weaker and we have few sellers. We have few sellers. That's what it indicates. So it's also possible for price to keep going up after the formation of this doji. That is why you are advised to wait for the next candle, which is this. This is the confirmation candle. This is the candle that confirms that, okay, there are sellers in the market. So you can see that this candle closed below the low of this doji. Can you see that? This candle closed below the low of this doji. So if you go by this, one would have expected a sell trade at this point. And what happened after executing a sell trade at this point? Okay, this is where you would have executed a sell trade at this point. Your stop loss would went in your direction just few pips. This didn't play out as expected. This didn't play out as expected. And if you go and check the calendar, it's most likely a fundamental news was released last Tuesday. That could be the reason this candlestick pattern didn't play out as expected. I want us to go to the calendar. It's most likely a major news was released last Tuesday? Let's confirm. Last Tuesday, what was the date for last Tuesday? Let's confirm. Last Tuesday was 18th. Okay, 18th. 18th of, okay, let's see. Okay, there was no major news for GBP and what's it called? And US dollar. The pair we are looking at is the US dollar, March 18th. There was no major news. Okay, so these didn't play out. Remember, you won't always win all the trade. Some will go the opposite direction, right? Most times it won't play out as expected. But before this pullback here, what happened? Price went down a little. Okay, okay, just did 11 pips, 11 pips, and your risk. This is where you would have set your stop loss. Your stop loss would have been 16 pips. The market went in your direction, 12 pips before pulling back. You can see. So this did play out as expected. Can you see that? So it won't always play out as expected. That is why you would always use stop loss. That is why you would always use stop loss. Stop loss is to stop your loss. Okay, stop loss is to stop your loss. Is to stop your loss. As a trader, you must accept the fact that losses are inevitable. You will make losses. There are no business that does not incur losses. If you know any business that does not incur losses, let me know in the comment section. There is no business. There is no business that does not incur. Every business comes with risk. Trading is a business, so you can't win all through. This didn't play out as expected. But personally, if I wanted to take a trade here after the formation of this doji, please pay attention here. For those of you trading candlestick pattern, after the formation of this doji, what you would have done after the formation of this doji, what I would have done here was to go down to 1 hour time frame. 1 hour time frame. The same pattern I'm waiting to see form on the 4-hour time frame. If I go down to 1 hour time frame and I'm able to identify that pattern on 1 hour time frame, I wouldn't have to wait for this candle to form before selling. I hope you're getting me. After the formation of this doji, if I go down to 1 hour time frame, which is the next lower time frame, if I'm able to identify a bearish reversal pattern on 1 hour time frame, I might not have to wait for this next candle to close bearish before selling. Another reason this candlestick pattern didn't play out, another reason this candlestick didn't play out as expected was the time it formed. For those of you trading candlestick pattern, you also need to consider the time that candlestick pattern formed. Most times when the candlestick pattern forms from 5 p.m. Nigerian time, most times it will fail. When a candlestick pattern forms from 5 p.m. Nigerian time, most times it would fail because the low or the high of that candlestick pattern becomes a level of liquidity, an area of liquidity that will be hunted before London session or during London session, and sometimes during New York session. Are you getting me? You also need to consider the time the candlestick pattern formed. Most times these patterns will play out as expected when they form during London session or New York session. But the ones that forms during the Asian session most times would fail. Most times they would fail. Take note of that. Most times they would fail. So if you look at the time this candlestick pattern formed, it formed, that's around 8 p.m., 8 to 12 Nigerian time. That is 6 to 10 p.m. Remember, the candlestick for the day closes by 10. So this candle started from 6 p.m. This candlestick opened 6 p.m. and closed by 10 p.m., which is late hour. And at that period, the volatility must have dropped. The volatility has dropped. So you identify this pattern when there's much volatility, when there's high volatility in the market. When this pattern forms, when there's high volatility in the market, it has a 70% or 80% probability of playing out. Okay, so consider the timing, the timing. So you can see now what I would have done here, like I said, was to go down to 1 hour time frame. After the formation of this doji, I would have gone down to 1 hour time frame. I hope you're still here. Can you still hear me? Can you still hear me? Can you still hear me? Are you still here? Let me know in the comment section. So if you go down to 1 hour time frame, you can see the pattern we had on 1 hour time frame. Can you see what we had on 1 hour time frame? We had a spinning top. We had what pattern is this? This is a spinning top. Then we have here we had a doji. You can see this indicates that the buyers are becoming weaker. So after the formation of that doji on 4 hour time frame, this is the pattern we had on 4 hour time frame. This is the pattern we had on 1 hour time frame. So what would I have done here in this case? If I would wanted to, but I don't trade at night. I don't trade at night. I don't trade at night. But if I wanted to take this trade, okay, I would have waited for a candle to close below the low of this candle, this last bullish candle. Okay, I would have waited for a candle to close below the low of this candle before selling. So my entry on this trade would have been at this point. That's about that should be 10 or 11 a.m., 11 p.m. Nigerian time. This is where I would have executed the trade. After the close of this candle, I would have waited for the candle to close below the low of this bullish candle. So if I'd taken that trade from this point, my stop loss would have been at this point. That's about 15 pips. Okay, my risk on this trade would have been 15 pips. And if I'm risking 15 pips on a trade, my first TP should be at least 25 pips. So let's see, the market went in my direction. How many pips? Just 15. Okay, just 17 pips. But my target was 25 pips, right? 25 pips. The market went in my direction, 17 pips. It didn't hit my target. So what would I have done on this trade? Can someone tell me, if you were on this trade, let's assume you took this trade, you executed this trade, and the risk you took was 15 pips, and the market went in your direction 17 pips, what would you have done? Let me know in the comment section. What would you have done? Would you have left the trade to pull back to hit your stop loss? Or what would you have done in this case? Or you would have just closed the 17 pips? Let me know in the comment section. What would you have done? Would you have closed that 17 pips? Or you leave the trade to pull back to hit your stop loss? What would you have done? Let me know in the comment section. Mr. Joseph said break even. What would you have done, Mr. Tonda, Mr. Raphael? What would you have done in this case? What would you have done? Break even. Good. Break even. Mr. Tonda, Mr. Anaya, what would you have done? Okay, break even. Yeah, break even. Break even. Okay. The best thing you would have done is to adjust your stop loss to your entry price. That's what break even means. That's what break even means. Adjusting your stop loss to your entry level. Okay, so that would have been the best thing. Or you would have, at least, since your risk was 15 pips and the market went in your direction 17 pips, you would have just adjust your stop loss 2 pips below, 2 pips below your entry level. So if the market pulls back, at least you would go home with just 2 pips. Okay, so it's either you break even or you adjust your stop loss 2 pips below your entry, so that at the end of the day, you go home with 2 pips if the market goes in the opposite direction like it did here. Like I said, I don't trade at night. I don't trade at night. If I don't see my setup between 3 and 5 New York session and between 8 and 11 London session, I don't trade for that day. I don't take any other setup. My setup, I should see my setup during London session, 8 to 11 a.m. Nigerian time, or during New York session between 2 to 5 p.m. If I don't see my setup during those period, I don't take a trade for that day. I don't take a trade for that day. Okay, so this setup was at night. So I wouldn't want to be awake by 12 a.m. Nigerian time. Should be sleeping by that time, right? So that's the reason I don't trade at night. It is stressful and the volatility in the market that period is very low. So why waste my time and risk my money trading during that period when there's no volatility in the market? Not be wise to risk money during that period. You want to risk your money when there is high volatility in the market. Okay, so that's it on Tuesday. So price went back, pulled back up, then it's actually sold. You can see what played out on that Tuesday. Can you see what played out on Tuesday? Like I said, okay, let me go back to 4 hour. Like I said, the high of this candle would always be used as liquidity. The high of this candle break even. Now, to set break even, you need to know the risk first on the trade. So let's say your risk on the trade is 30 pips. Once the market moves in your direction 30 pips, you can adjust your stop loss to break even. Okay, if your risk on the trade, your stop loss is 30 pips, immediately the market moves in your direction 30 pips, you should adjust your stop loss to break even. If the market moves in your direction 40 pips, then your stop loss should be 10 pips below your entry level. I hope that is clear. If the market moves in your direction 30 pips, adjust your stop loss to break even. If it moves in your direction 40 pips, adjust your stop loss to 10 pips below your entry. If it moves in your direction 50 pips, adjust your stop loss 20 pips below your entry. Most people, immediately they see profits, they just adjust their stop loss to break even. And what happens most times, the market pulls back and hits their stop loss. That's what most traders do. Immediately they see 10 pip profits, they adjust stop loss to break even. That's not the right way to adjust your stop loss. That's not the right way to trail your stops. Ensure that the risk you took on that trade, you are in profit equal to that risk before you adjust your stop loss. You don't just adjust your stop loss because you've seen some pips. No, that's a wrong approach to trailing stock. Okay, so like I said, the high of this candle, when all this pattern forms at night, most times they use the high and the low of that candle as liquidity. They use it as what? Liquidity. What is liquidity? Liquidity is an area where there are a lot of orders. We can say there are a lot of orders in an area of liquidity. Do you get that? Liquidity is an area where you have lots of orders. Some, like ICT students, order block is an area where there are a lot of orders. Another block is an area where you have a lot of orders. So institutions, now you need to know how institutions operate. Banks like Goldman Sachs, when they want to execute trade, when they want to place orders, their orders is in millions of dollars, not $10, not $20. Their orders is in millions of dollars. Now, I believe you know that for every trade you execute in the market, if you buy, there must be someone on the other side who is willing to sell. I hope you know that when you execute a buy trade in the market, there must be someone at the other side who is willing to sell. Okay, now when these banks, these institutions come into the market with their millions of dollars, they can't just execute trade at any price. For example, if Goldman Sachs wants to sell, they want to execute their trade at levels where there are a lot of buy orders. Where there are a lot of buy orders, that is where they would execute their trade. I hope you're getting me. If they want to sell, they want to execute their trade where there are a lot of buy orders. And if they want to buy, they want to execute their trade where there are a lot of sell orders. Are you getting me? Are you getting me? So the high of this candle is an area of liquidity. And what played out on Tuesday? Look at the chart. What played out? This was the first candle on Tuesday, second, third, fourth, 1, 2, 3, 4, 5, 6. Can you see that? So see what played out on Tuesday. See what played out on Tuesday. Let's go to 1 hour. Let's go to 1 hour. You would see. See what played out. Can you see it? Can you see what played out? Can you see? This was the high of that doji. This was the high of that doji. What played out? Can you see what played out? They actually pushed price up to clear all the stop losses. Remember, when you place a sell trade, your stop loss is a buy order. How many of you know that? How many of you know that? How many of you know that? When you place a sell trade, your stop loss is an order to buy. And when you place a buy trade, your stop loss is an order to sell. How many of you know that? So they know a lot of retail traders would have executed sell after the formation of that doji, because that's what we teach you. That when you see a doji, it's time to sell. So they know most retail traders would have executed sell. That's what we teach now, right? That's what we've learned. That's what we're taught. And when a doji forms, it's time to sell. So most people would execute sell, right? Most people will execute sell trade, right? And their stop losses will be at this high or a few pips above this high. So you can see what played out on Tuesday. They pushed the price up. Can you see that? What they did was to push the price up. What happened? Immediately they cleared the stop losses. What happened? You can see how price dropped. You can see how price dropped. The bearish move was aggressive. So the first thing they did was to sweep liquidity residing at this previous high before going bearish. And you can see after they cleared liquidity, look at the pattern that formed here. We had an hanging man. This is a bullish hanging man. And the next candle closed bearish. The next candle closed bearish. So your entry would have been at this time. You can see I said when this pattern forms during the New York session or London session, it has a high probability of playing out than when it forms in Asian session. So you can see after the formation of this hanging man, you would have waited for this candle to close before you sell. You can't jump in after the formation of this hanging man. You would have waited for this next candle to close bearish before you execute a sell trade. So the sell trade would have been executed at this point. This is where you would have entered sell. And if you sold from this point, your stop loss, you can use the high of this candle. You can use the high of this candle or the high of this candle. So if you had executed this trade from this point, okay, you would have risked 14 pips. And if you are risking 14 pips, your TP will be what? Your first TP should be at least 25 pips. 25 pips. Your first TP should be 25 pips. So let's see if the markets actually, you can see. Can you see the reward? So if you had even gone for 1 to 2 risk reward on this trade, risking 15 pips for 30 pips, the market would have hit your TP at this point. Can you see that? And this occurred during the New York session. This pattern formed during the New York session. So please, when those pattern forms, anything from 5 p.m., ignore it, because the high or low of that pattern most likely will be used as liquidity during the London session or New York session. Okay, so let's move to the next day, which is Wednesday. We've looked at Monday. We see how the market reacted after the formation of that hammer. And on Tuesday also, we've seen how the market reacted after the formation of that doji candle. So if you had executed a sell trade after that doji. Also, when you are trading Asian session is not always volatile. The range of Asian session most times is between 20 and 40 pips. The range of Asian session is between 20 and 40 pips. It means if the range is 20 to 40 pips, any trade you're going to take during Asian session, your risk should not be more than maybe 15 pips, and your reward should not be more than 30 pips. If you're trading Asian session, you cannot be trading Asian session and you are aiming for 60 pips, 70 pips. You need to know these things. You cannot be aiming for 70, 100 pips in Asian session. The only time Asian session will be volatile is maybe there's a major news coming from Australia or Japan or New Zealand. It's during those sessions from 12, 11 p.m., 1 a.m. That's when news from New Zealand, Australian dollar, I think Japan also, that is when they release those news. When a major news is released at that time, most times it will be volatile. But most times the range is between 20 and 40 pips. So if you are aiming for 100 pips during Asian session, most times your stop loss will be hit. Most times your profit target will not be achieved. And you pray that if it's not achieved in Asian session, you pray that the London session, it will hit your TP in London session. I hope you are with me. But at times it's painful when after hitting your break even, they're moving your direction. It's fine. You would experience that. It's inevitable. You would experience that, but it's better to close the trade at break even than for it to go and hit your stop loss and you lose on that trade that has gone in your direction in profit. Which is better? Is it not better for you to close at zero profit than for the market to go against you and hit your stop loss? It's better it's break even, because on that trade you've not lost money. So it's best to allow it, let it hit your trade, let it hit at break even than retracing to hit your stop loss. Okay, there are, I think, 4 or 5 possible outcomes when you execute a trade. It's either you hit TP, that's large profits. I think these are the outcome: large profits, it's profit, small profit. Okay, these are the outcomes of a trade: small profit, break even, small loss, big loss. These are the outcome of trades. When you execute a trade, it's either the market hits your TP, you make good profit, sometimes small profit, right? Small profit, sometimes break even, sometimes you make small loss, sometimes you make big loss. These are the outcome, 5 outcomes when you execute a trade. And you should be okay with the outcome. You should be okay with any of this outcome. Okay, you should be okay with any of this outcome. Small profit, break even, small loss, small profit, big loss. Okay, you should be okay with the outcome of any trade you execute in the market, because before you execute the trade, you've already planned the trade. You've determined how much you're going to lose. So it shouldn't take you by surprise that the market pulls back to hit your stop loss or hits your trade at break even. It shouldn't surprise you. If you're an experienced trader, nothing should surprise you in the market, because before you execute a trade, you must have planned the trade. You must have planned the trade. It's only when you execute a trade without a plan, that is when you should be surprised at the outcome. Okay, so let's move to the next day, which was on Wednesday. So on Wednesday, this was Tuesday candle. So what we're actually doing now is backtesting. We're doing a review of how the markets reacted to all this candlestick pattern. Like I said, the strategy we are backtesting now is candlestick pattern. Okay, candlestick pattern, resistance and support. That's what we're backtesting. We're looking at how the market reacted to these patterns this past week. Okay, so on Wednesday, what do we have on Wednesday? This was on Tuesday. Then on Wednesday, this was Wednesday. Okay, so we had on Wednesday. This was the last candle on Tuesday. Can you see this? This was the last candle on Tuesday. Can you see this? And this candle formed as what? This is a shooting star, right? This is a shooting star, which indicates change in trend from bullish to bearish. This is a shooting star, which indicates change in trend from bullish to bearish. Now, because the body of this shooting star is bullish, because the body of this candlestick is bullish, it indicates that we still have few buyers in the market. It indicates we still have few buyers in the market. So the rule is to wait for the next candle to close bearish. So your entry on this pattern would have been this, the close of this candle, the close of this candle. That would have been your entry. And I think the close of this candle is below the low of this shooting star. The close of this candle, the closing price here, is below the low of this shooting star. That indicates that supply is increasing and demand is decreasing. That's what it indicates. Supply is increasing and demand is decreasing. So if you had executed this trade after the formation of this pattern, now this pattern formed in Asian session. This was the last candle for the day. Okay, this formed in Asian session. Now, if you had executed this trade from this point, your stop loss would have been at this high. Your stop loss would have been at this high, and your TP. Let's see. Your risk determines your reward. Your risk determines your reward. If you can define the risk on the trade, you should know what your reward is. Okay, so the risk here, you can see the risk here is 15 pips. So if you risk 15 pips, 15 pips times 2, that's 30 pips, right? That's 1:2 risk reward. Let's see. You can see. So if you had risked 15 pips from this point, by now at this point, you can see the market went in your direction 40 pips. The market went in your direction 40 pips, right? Stop loss is 15 pips and our target is 30 pips. So you'd have made, can you see, you'd have made 30 pips on this trade. So this actually played out, though it formed during the Asian session. Like I said, the range of the Asian session is between 20 to 40 pips. 20 to 40 pips. If you had aimed for 100 pips here, what would have happened later in the day? It would have gone for your stop loss. You can see. So it's very important that you know the market you're trading, know the volatility, know the range of that instrument. Are you getting me? You need to know the range of that instrument during that session. Okay, so this played out. Now, what happened here? Remember, I said this level would always be used as an area of liquidity. You can see that this high here will be used as an area of liquidity, and that was what played out here. Can you see this? I think this was the first candle for Thursday, right? This was the last candle for Wednesday market, for Wednesday. So they actually came for the stop losses. Can you see? On Thursday, what they did, the first thing they did was to clear all the stop losses that was residing at the high of Wednesday. The high of Wednesday. That was what they did. The first thing they did on Thursday. That was the first thing they did. So let's go back to daily. So on Thursday, this was the first candle on, this was Thursday candle. Thursday candle. So let's go back to 4 hour. So on 4 hour, you can see this was the last candle for Wednesday. This was the last candle for Wednesday. And the high of this last candle and this previous high, okay, they actually cleared the high of this doji on that same day, that Wednesday. This candle was used to clear the high of this shooting star that formed on Tuesday. Can you see that? Then on Thursday, this was the first candle on Thursday. Can you see this candlestick pattern? Okay, so you can see the pattern that we had here. This was the first candle for Thursday. Okay, and that candle looks like, it looks like a spinning top, right? You can see this candle looks like a spinning top. So yeah, this is a spinning top, and the next candle closed bearish. So our sell on this pattern would have been after the close of this candle, because the body of this spinning top is bullish. So we would have considered selling after the formation of this bearish candle. Are you with me? That the body of this candle, this spinning top close bullish, indicates that there are still buyers in the market. There are still buyers in the market, but it's telling us that the buyers are becoming weaker. That's what this spinning top pattern communicates. Okay, that okay, the buyers are becoming weaker. But before we jump in and start selling, we need to wait for the next candle to close bearish. So on Thursday, we would have taken a sell after the formation of this candle, and our stop loss would have been at this high. So the stop loss here would have been 15 pips, let's say 15 pips, and our target will just go for 30 pips. And you see that? So on Thursday, we would have made profits on this trade. Can you see that? Can you see that? Just trading candlestick pattern. Just trading candlestick pattern. So this was Thursday move. Then on Friday, what happened on Friday? The trend continues. The trend continued. You can see. You can see the trend continued on Friday. Because here we had an angry man, we had a doji, and the rule is after this angry man and doji, wait for the next candle to close bearish. So Thursday candle closed bearish. So we should have expected price to drop. Can you see that on Friday? Because what we have here is a bearish reversal pattern. It's a bearish reversal pattern. And if we go down to 4 hour after the formation of this candle on daily, let's see what we had on 4 hour. So I think on 4 hour, you can see on 4 hour, a candle closed below the low of the previous day candle. This level, this support that the market has been struggling to break out from on Tuesday, Wednesday, on Thursday, if you go down to 4 hour, you can see 4 hour candle. This candlestick closed below the low. You can see it, which indicates that supply has exceeded demand. And when supply exceeds demand, what happened? Price is expected to drop. And you can see what happened. That was what played out on Friday. Can you see that? Can you see that? Can you see that? So that is how you backtest. Let's still go back and do some more backtesting. Okay, let's go back and do some more backtesting. So here we had a spinning bottom. Can you see this? This is a spinning bottom, and after the formation of this spinning bottom, you have to wait for this next candle to close. We're on a daily time frame. This is a spinning bottom. The next candlestick engulfed it. This is a bullish engulfing pattern. And what happened after the formation of the engulfing pattern? Price went up. Can you see? Price went up. Here we had a spinning top also. Waited for this next candle to close bearish before taking a sell. Now, if you are taking a sell on this trade, this would have been a loss, right? Because you would have waited, if you go by the rule, you would have waited for this candlestick to close before entering a sell trade, right? You would have waited for this candle to close. This is a bullish spinning top. Wait for the next candle to close. So if you had executed the trade from this point, your risk, this is where you would have set your stop loss, right? Your stop loss would have been at this point. A few minutes, please. Okay, so if you are taking a sell on this trade, this would have been a loss. Your stop loss would have been this much. And you see this risk is too high. You sure wouldn't want to take this trade, right? You sure wouldn't want to take this trade because the risk here is too high. 114 pips. That risk is too high. You sure wouldn't want to take this trade because the risk is too high. Anything above 30 is not a good risk. Anything above maximum 40 or 50 pips, anything above, if you calculate the risk involved and it's more than 30, 50 pips, you should not take the trade. So this wouldn't have been a good trade. Can you see that? Because your risk, it will be too high. 113 pips. 130 pips. And the market just went in your direction. How many pips? 41 pips. 41 pips. But if you insist on taking this trade, if you still insist on taking this trade, you're sure that your stop loss does not exceed 30 pips. Are you getting me? You use your fixed stop loss, 30 pips. Then you aim for maybe 50 pips. The market just went in your direction, maybe 40 pips, and it pulled back. So you would have at least made like maybe 5 or 10 pips on this trade. But taking a risk of 1 and something, that risk is too high. You don't take such risk, it's too high. 100 and something pips, no. Don't take such risk. So what time did this candlestick pattern form? Okay, this was 12 to 4 a.m. 12 to 4 a.m. Nigerian time. This candlestick formed 12 to 4 a.m. Nigerian time. So what you would have done here, for those who trade, who would love to trade Asian session, what you would have done here is to go down to lower time frame. When you're analyzing the markets, it's very important that you use different time frames. Okay, you use different time frames. Your approach should be top-down analysis. Okay, it's very important that you know the trend on the higher time frame. You go to lower time frame to identify entry levels. Note that when you're analyzing the market, you should know the trend on the higher time frame. Monthly, weekly, daily. If you're a day trader, you should know the trend on a daily time frame. Then you go down to 4 hour, ensure that the pattern you're seeing on 4 hour conforms to the pattern on the daily time frame. So if your bias on the daily, based on the candlestick that formed on the daily, if your bias is bearish, when you go down to 4 hour time frame, you want to also ensure that the pattern you see on 4 hour time frame conforms with the higher time frame. Then you can go to 1 hour 15 minutes to look for best entry zones. You go to lower time frame to look for your area of interest, your entry zones. Okay, that is the way you should do your analysis. Some people use just one time frame for the analysis and it is working for them. It is working for them. They just use one time frame. But I think it's best when you use different time frames. You should have the higher time frame, the medium time frame, and the lower time frame. That is how I analyze the market. I use 3 time frames. The higher time frame is to know the trend on the higher time frame. The medium time frame is to know the trend on the medium time frame, and the lower time frame is to look for my area of interest, my area of entry. Okay, that is how I analyze the market using different time frames, and that approach is called top-down analysis or multiple time frame analysis. Top-down analysis or multiple time frame analysis. So after the formation of this spinning top on the daily time frame, after the close of this candle, what I would have done here is go down to 4 hour time frame, which is the next lower time frame. So the daily, I'm using the daily as my higher time frame in this case. So since a spinning top formed on a daily time frame, this tells me that there's a high probability the price will pull back, price will drop. But if I go just by the daily pattern, I need to wait for this next day candle to close before I will take a decision on this. But since the daily has indicated that there's a possibility for price to pull back, now all I need to do is go down to 1 hour. Sorry, 4 hour, which is the next lower time frame. I'm going down to 4 hour to identify the pattern on the 4 hour time frame. If I go down to 4 hour and I'm able to identify a bearish reversal pattern, I wouldn't wait for this next candle to close. Are you getting me? I wouldn't wait for this next candle to close before I will take a trade. So let's go down to 4 hour. Let's see what we had on 4 hour. So you can see what we had on 4 hour time frame. You can see we had a bearish reversal pattern on 4 hour time frame. Can you see this? Can you see the pattern we had here? This is a shooting star. This is a shooting star, and this also is a shooting star. This is a bullish shooting star. So what we would have done here is to wait for this next candle to close bearish. So immediately that candle formed, that what's it called? That spinning top candle on the daily time frame. This would have been the entry. This would have been the entry after the close of this candle. That would have been the entry for this trade. So if I had executed a sell from this point. Let's calculate the stop loss. Okay, like I said, it should be between 30, maximum 50 pips. Maximum 50 pips. So if I had used 30 pips here, your stop loss would have been few pips above the high of this candle. Okay, let's say your stop loss is 30 pips and you go for, let's say, 60 pips. That's 1 to 2 risk reward, 60 pips. So at this point, this is where the market would have hit your TP, this point. Okay, this is where the market would have hit your SL. Are you guys still here? Are you still here? Are you still here? Do you have any questions so far? Do you have any questions so far? Do you have any questions so far? So, we're putting our stop loss at the highest of the previous candles with some additional pips. Yes, yes, you can add. You can set your stop loss few pips above the high of the candle or the low of the candle. If you are buying, set your stop loss few pips below the low. Let's say, depends on how volatile the market is. Depend on the session. If it is New York or London session, you can set it 10 pips. Okay, 10 pips, at least 10 pips below. If it is Asian session is not as volatile as the New York and London session. Your stop loss should be set between 5 and 10 pips. But for New York and London, your stop loss should be at least 10 pips below or above the high of the candle. I hope that is clear. I hope that is clear. So you can see how the market reacted to this candlestick pattern. You can see how the market reacted to this candlestick pattern. All we've been trading with, or all we've been analyzing with, is candlestick pattern. That is all. And you can see how the market respected these patterns. It keeps repeating itself. It keeps repeating itself. Okay. Any question? Do you have any question? Do you have any question? Any question? I think we should have our weekly market outlook session tomorrow. Okay, our weekly outlook session will be tomorrow by 9 or 10 p.m. What time will be convenient for the session? Let me know in the comment section. 9 or 10 p.m. tomorrow. Our weekly outlook session would hold tomorrow 9 or 10 p.m. What time will be convenient? Please let me know in the comment section. So that's how you backtest strategy. For example, some people use 200 moving average. Let's just apply 200 moving average. Okay, let's apply 200 moving average on the charts. Okay, whatever strategy you learn, you should do a backtest. Okay, do a backtest. Let me change to naked charts. So if you want to apply 200 moving average, let's see, 200 moving average is used to define the trend of the market. Okay, 200 moving average is used to define the trend of the market. When the market is trading above the moving average, when the market is trading above the moving average, the market is said to be bullish. When the market is trading above the moving average, it is said to be bullish. And when it is trading below the moving average, when price is below the moving average, it tells you that there are more sellers in the market and the trend is bearish. Okay, when it is above, you look for buy. When it is below, you look for sell. So if you apply that on, this is the daily time frame. Let's just see. So you can see there was a crossover from here. This candlestick closed below the 200 moving average. What happened? What happened? Price dropped. It sold. And what happened from this point? Price pulled back. You can see it pulled back, tested. Now, this moving average is also used as resistance and support level. Moving average is also used as resistance and support level. So you can see this moving average, the 200 moving average, acted as a resistance level. And after price tested the moving average, look at the pattern that formed there. Look at the pattern that formed there. So if you're trading with the moving average, you should also look at for the candlestick pattern that forms after price tests that moving average. So price tested that moving average, what pattern that formed? It's a bearish reversal pattern. These are things you look out for when you are back testing. You just go back, okay, let's see when price tested 200 moving average. Okay, this moving average was used as a support. Okay, so what candlestick pattern formed? You can see we had a doji here, and this next candlestick closed above the doji. This is an engulfing pattern. You can see how it's played out. These are the things you look out for. You observe as you are going back. You observe. You take notes. Okay, you take notes. Then you later go back and test. That's how you build a system. Okay, so you can see at this point, price is trading above the 200 moving average at the moment. This tells you that the trend is still bullish, right? You can see after price broke out from the moving average, price went up. So if you had executed buy after this candlestick closed above, you could have set your stop loss. So all these things you would observe as you're looking at the chart. So if I had set my stop loss here, what would have been my risk on this trade? These are things this is how you backtest. What would have been my risk here? Okay, this is like 100 pips. 100 pips, let's say I go for 150 pips, you can see that's swing trade. That's swing trade. Okay, so you see 118 pips. Let me go for 200 pips. 200 pips at this point, you would have made over 200 pips at this point. Okay, so what happened here? Like I said, price tested this 200 moving average. It acted as a support, and price dropped from that area. Here also, price broke out from the 200 moving average. You can see here also the markets closed above the moving average here. You can see what happened. Price went up, and what candlestick pattern formed here? This is an hammer. This is an hammer, and this hammer broke out from a resistance level. You can see it broke out from a resistance level, and price went up. Okay, you can see because the market is still trading. So when the market is trading above the moving average, all you'll be looking out for is a buy pattern, a bullish reversal pattern. That's what you'll be looking out for. Anytime the market is trading above the 200 moving average, you just be looking for buy patterns, buy bullish reversal pattern, breakout from resistance. Those are the things you'll be looking out for. Okay, and when the market is trading below the moving average, you're looking out for bearish reversal pattern, breakout from support. Those are the things you look out for. 9 p.m. Okay, so tomorrow by 9 p.m. Okay, someone said 10 p.m., someone said 9 p.m. Okay, so whatever strategy you learn, apply it on the chart, do backtesting, backtest to know how effective the strategy is. Okay, do a lot of backtest. So you can see here there was a breakout. Okay, you can see here also the moving average was used as a resistance here. Can you see it? A doji spinning top, bearish spinning top, sell. Also, the market attempted this moving average. It approached it, but it didn't get there. But you can see the pattern that formed. This is a bearish reversal pattern that formed. That's to tell you that the sell continues. Okay, because price didn't break out from the moving average. You can see here also it acted as a resistance. Look at the pattern that formed. You can see price couldn't break out from that moving average. That tells you that the sell continues. The bears are still in control. You sell. Okay. So here there was a breakout here. It closed above it, but this one failed. It failed. You can see this one failed. There was a breakout from this point, went bearish. You can see that. Also here, also this candlestick closed above the moving average. What happened? It went up. Can you see that? Okay, 9. Okay, so tomorrow by 9, I'll drop the link later. You can see here also the 200 moving average acted as what a support. You can see it acted as a support. You can see that it acted as a support. Price went up. Also at this point, it acted as a support. And look at the candlestick pattern that formed at that support level. You can see it bought. Okay, you can see here also it acted as a resistance. It acted as a resistance here, acted as a resistance here. You can see after price broke out from the 200 moving average, you can see price dropped. Here it went above it. What happened? Price went up. Okay. Here also there was a breakout from the moving average. Price dropped. Sometimes it will fail. Sometimes it would fail. Like I've always said, your system, you can't find a system that has 100% winning rate. If you have a system that has a 60% winning rate, that's a good strategy. If out of 10 trades, you are able to win 6 trades out of 10 trades, you have a good strategy. Okay, you have a good strategy. There's no strategy that will generate 100% winning rate. Every strategy would experience losses. Okay, every strategy would experience losses. Okay, so I think we've covered a lot tonight. I hope you all got value from this session. If this is your first time participating in the live stream, please do subscribe to the channel so that anytime I come on live, you get notified by YouTube. And if you're yet to like this stream, please give it a thumbs up so that others can get to see this video. Okay, please give it a thumbs up. If you're yet to like this stream, please give it a thumbs up. I hope you all got value from this session. So let me just take questions. If you have any question, drop it in the comment section in the next 5 minutes. So by 11:25, we'll be done with the session. Do you have any question? Let me know in the comment section. Let me know in the comment section if you have any question. I appreciate you all for your participation. To be in this class. That tells me that you are interested in your success. That tells me that you are interested in your success. You are determined to succeed in this business. I'm not a pro using a moving average, Mr. Joseph. I'm not a pro using moving average. But like I said, you can decide, okay, the candlestick that breaks out from that moving average. Like for example, what we have here, those are the things you take notice of when you are backtesting. Okay, those are the things you take notice of when you are backtesting. So when this candlestick broke out from this moving average, okay, what happened? Price went up. So if I set my stop loss at this low, okay, calculate the risk involved. Okay, I risk 100. So like here also, this moving average, okay, acted as a resistance. I had the candlestick pattern here. Then you should know your stop loss will be the high of this candle or few pips above the high of this candle. These are the things you take notice of as you back test. Okay. So for example, this candlestick broke out from this moving average. I can decide, okay, my stop loss will be the high of this candle. Since this was the candle that was used to break out from the moving average. So my stop loss will be there. Calculate the risk involved. Okay. And as you can see, the risk is about 120 pips, but you can see that the market doesn't even approach the moving average. You can also decide, okay, I will use the moving average value as my stop loss. This moving average, this should be like 70 something pips. Then you go for, let's say, 100 and something pips. You can see, you can even decide, okay, once a candle breaks out from the moving average, like we have it here, okay, I don't want to risk more than 50 pips. And if I'm risking 50 pips, my target is 100 pips. You understand all these things as you backtest. For example, look at what played out here. After this candlestick broke out from this moving average, you decide to buy, though the risk, if you have set your stop loss here, okay, 100 and something, but did the market retrace 50 pips? No. So you can decide, okay, let me use 50 pips as my stop loss, 100 pips as my take profit. Can you see that? Those are the things you take notice of as you are backtesting. Okay, look at what we have here. We had this moving average was used as a support. And since I have a bullish reversal pattern here, I decided to take a trade from this point, my stop loss will be here, right? Stop loss, or if you decide you want to use fixed stop loss 50 pips, the market still didn't pull back 50 pips before going in my direction. So I can decide to just use 50 pips as my fixed stop loss and my TP 100. Are you getting me? So these are the things you take notice of as you're back testing. So look at what we have here. Strong bearish move here, engulfing pattern. It broke out. So if I decide to sell from this point, set my stop loss here. This risk is too high for me. Okay, let me decide to work with 50 pips. Set my stop loss 50 pips. So 50 pips will be at this level. And I go for 100 pips. You can see. Can you see that? Yeah, also there was a breakout. If you decide to buy from this point and you still work your 50 pip risk, let's see. 50 pip risk, let's see. Okay, this one would have hit your SL. This one would have hit your SL. If you had used 50 pips, it would have hit your SL at this point. Okay, but it's the number of times that it actually played out that's more important. Okay, so look at what we have here. This candlestick closed below the moving average. I decided to take a sell after this candlestick broke out. We're on a daily time frame. Okay, so 50 pips stop loss. So my stop loss would have been at this point. Did the market get there? No, it didn't get there. Go for 100 pips, you would have hit this. So as you are backtesting, you are taking notice of all this. What happened after the market closed above? Look at this here. The market, we had a spinning bottom here. The next candlestick closed above the moving average. I decide to buy. If I decide to buy above the moving average, I'm still working with 50 pips. 50 pips. My stop loss would have been at this point. 50 pips and my TP 100 pips. It actually paid out. So these are the things you look out for when you are backtesting. I hope that is clear, Mr. Joseph. Let's see. So for example, we had this, the market was used as a resistance, as the moving average was used as a resistance. Your stop loss definitely would be the high of this candle or a few pips above the high of that candle. This candlestick broke out, close below the low of the moving average. Okay, you decide to sell, you're still working with your 50 pip risk, 100 pips take profit. So 50 pips, okay, your 50 pips will be, this is the candle that broke out from there, your 50 pips. Okay, 50 pips would have been at this point. What happened? Did the market pull back to that zone? No. 100 pips, it went in your direction, you would have made profit. Okay, so that's just it. 50, 100, 50, 100. If you're working with risk reward of 1 to 2, you just need to win 5 trades out of 10 trades. Even if you win 4 trades out of 10 trades with a risk reward of 1 to 2, you'll still make profit. You'll still be in profit after 10 trades. I hope that is clear. How do you use top-down analysis using? I'm not saying the question. I'm not saying the question. Using, like I told you, I'm not a pro in moving average. Okay, I'm not a pro in using moving average. I'm not a pro. I'm just showing you how you can develop a strategy. Okay, how you can develop a strategy, how you should back test. That's what I'm just showing you. I'm not a pro. So when it comes to top-down analysis using MA, I'm not a pro in that area. I only teach you what I know. Okay, I'm not a pro in that area. Using moving average. Unless you want me to develop a strategy on using moving average, and I don't think I have the time for that now. When you have something that works for you, it's best to just stick to it. So I have a system that works for me, so I don't have the time, developing new strategies. Okay, like I don't use indicator. I don't use indicator. I've passed that level. Years back, I used indicator, but now I don't use indicator. I started with indicator. I've used several indicators, stochastic, RSI, MACD, MACD. I've used SAR, parabolic SAR. I've used Bollinger, Bollinger bands. I've used several indicators. Okay, several indicators. But these days I don't work with indicators. Okay, I don't work with indicators. If at all I want to use indicators now, it would just be for confluence. I use price action, candlestick pattern, resistance and support, some ICT concepts like fair value gaps, okay, liquidity concepts. Those are the things I use in trading. Pure price action, pure price action. I've used moving average, 41263 moving average, 50-20-10 moving average. I've used lots of indicators. I've used lots of indicators. I started with indicators. I started with indicators. So I think that will be all for this session. So we'll be meeting tomorrow by 9 p.m. 9 p.m. tomorrow for our weekly review and outlook session. Weekly review and outlook session. So once again, I want to appreciate you all for your participation in tonight's session. I want to believe you got value for your time. I want to believe you got value for your time. I wish you all a wonderful night. See you tomorrow in class.